Global financial markets are witnessing increased volatility as tension between the United States and Iran continues to escalate. Investors around the world are becoming concerned about the possibilities of a border conflict in the Middle East, a region that play a crucial role in global energy supplies. As a result, we are seeking a classic risk of reaction in the financial market. Stock markets are declining, bond markets are under pressure, and crude oil are moving higher as traders anticipated potential supply dispute. In today's video, we will break down what is happening, why market are reacting this way, and what investors should watch moving forward. What triggers the market reaction? First, recent development between the United States and Iran has increased geopolitical uncertainty. Whenever tension rises in strategically important region, investors become concerned about economic stability, trade flow, and energy security. The Middle East accounts for the significant share of global oil production. Any conflict involved major oil production nations can immediately impact energy market and investor sentiment. This uncertainty has pushed investors to reduce exposure to risky asset and move towards safer position. So next, why are stock markets failing? Stock markets generally disliking uncertainty. When geopolitical tension increased, investors worry about slower global economical growth, rising energy sector, high inflation, reduced consumption spending, and a potential distribution to international trade. So generally, this is how things. So technological stock, growth companies, airline transportation firm, and manufacturing businesses are often among the first sector to experience selling pressure. Investors are essential pricing in the possibilities that higher energy price could hurt corporate profile and economical activity. Third one, why are oil prices rising? The biggest beneficiary of the current situation is crude oil. Iran is one of the world's major oil producer, and the Middle East is a home to several critical oil exporting nations. One of the most important concern in the Strait of Hormuz. This narrow waterway handle a significant percent of the world oil shipment. If tension threatens shipping routes or oil infrastructure, traders immediately begin pricing in the risk of reduced supply. When supply concern rising, oil price generally move higher. This is exactly what we are seeing in the market today. And fourth one is, why are bond failing too? See, stock market is different, bond is different. So why bond also failing too? Normally, during uncertain times, investor buy government bonds as a safe haven. However, this situation is slightly different. Higher oil price can lead to higher inflation. If inflation rise, central bank may delay interest rate cut or even consider tightening the monetary policy. So when investors expect inflation to remain elevated, bond yield tend to rise and bond price falls. So that is why both stock and bonds are also experiencing pressure simultaneously. So now, which sector could benefit? Not every sector suffered during the geopolitical tension. Potential beneficiary includes oil and gas companies. Second one, energy producers. Third one, oil field service companies. Fourth, defense and military contractors. Finally, commodity related business. These industries may experience increased demand or higher revenue if tension continues. What should investor watch next? There are four key developments to monitor. First, whether diplomatic efforts reduce tension or whether the conflict escalate further. Second, movement is in crude oil prices. Third, any disruption to shipping routes in the Middle East, especially the Strait of Hormuz. And fourth, upcoming inflation data and the central bank statement. These factors will determine whether the current market volatility remain temporary or develop into a broader economical concern. So finally, rising US-Iran tension has created uncertainty across global financial markets. Stocks are falling as investors become cautious. Oil prices are rising because of concern about supply disruption. Bond market also under pressure due to inflation fear. The coming days will be critical in determining whether this remain a short-term geopolitical shock or evolve into a large economical issue.